Welcome to Any Answers Answered for October. This month, Tim and I have chosen a couple of questions from the Any Answers pages. The first one is the person, I'm not even going to attempt to say who it is, it's a number. And they have raised a question about an inquiry that has started for one of their clients. And the situation, Tim, is they've had an inquiry from the revenue. They've decided private health insurance, which we have treated as director's loan account and subsequently dividends, should be treated as earnings. In addition, most of the motor expenses they want to treat as earnings rather than added back to the corporation tax comp. Not too worried about the motor expenses. I'm concerned about the way they've dealt with this private health insurance. Now, I think there's two different ways of doing exactly the same thing. One results in a tax charge, one doesn't. The situation here is, are the revenue right to argue this should be treated as earnings, this private health insurance? I think we're going to conclude probably are. Yes.
I think we are. The questioner, it's 0098087, does say at the end of his question, of course, clients won't listen when told not to pay private bills out of the business account. Confirming,
and that's the point,
that what's happened here is that the director shareholder has arranged their own medical insurance with Bupa, AXA, whoever it is, but instead of paying the premium personally, they've got their company to pay the premium. Well, it's not until quite low down in the thread that another accountingWEB member, John R, gets to the nub of it, and it's really quite straightforward. If an employer meets the pecuniary liability of an employee, then that is a trigger for PAYE and NI at the time the payment is made. So we can't indeed have directors taking their personal electricity bill, council tax bill, medical insurance bill into the company and saying to the bookkeeper, oh, pay this for me, will you? It doesn't matter what the double entry is. The payment of that bill is meeting pecuniary liability of the director, and that does trigger PAYE and national insurance at that point. So the revenue are quite right to query that. Now, the question then is, how do you settle it? And before looking at that, let me pick up on what you were, I think, driving at, which is the distinction between this scenario and what happens if there is a benefit in kind. This is not a benefit in kind.
So if we just take a step back there, so if PTP Limited pays my gas bill for me, the gas bill saying my name and my home address, that is a pecuniary liability met on my behalf by the company, taxable on me, full stop.
Correct.
Conversation.
With 13.8% secondary class 1,
absolutely
payable by the company.
If by some bizarre world the gas bill is in fact the liability of the company,
yep,
and that is a benefit which the company has agreed to meet and then give me as one of my benefits, then the rules are very different.
Well, if it's a benefit in kind, and perhaps let's move away from your gas bill and go back to medical insurance, because of course that is fairly standard practice for an employee to be covered on a medical insurance premium policy by the company. Then you've got a benefit in kind, and the benefit in kind will either be dealt with through the payroll, or if it's not payrolled, it'll go through the P11D, and then the employer will pay Class 1A on the P11D benefit. However, because we're now looking at the benefits code, the legislation now allows that if the director makes good the benefit by the 6th of July following the tax year, and this came in this year, 17-18, the benefit won't be chargeable as a benefit. So a director in that scenario would be able to reimburse the company either by a direct cash transfer, or it could be by having the benefit debited to a director's loan account, as has happened in this case, and that would extinguish the tax and NI liability on the benefit. But we're not talking about a benefit here. We are talking about settling a pecuniary liability.
And I think what is interesting is that the person who has posted this has effectively given the correct answer.
Yes.
For the benefit scenario, but has asked the question relating to a pecuniary liability met, and that's why they have got themselves confused. Yeah. It would have worked had it been a benefit, but because it wasn't a benefit, sadly, we think it is taxable. The revenue are probably right. The other question to look at is from Pete57 relating to Form 17. And with the greatest respect to Pete, I'm not even going to read the entire question. I'm simply going to read about 3 lines of it, and that enough is for us to discuss the fact that people keep getting Form 17 wrong. He says, as I understand it, Form 17 allows you to change the underlying beneficial interest in a property. No, it doesn't. To change the rental income proportions to enable profit shifting between man and wife or any other parties. No, it doesn't.
No. The Form 17 was introduced when independent taxation came in back in 1990-91. And the default position where property is jointly owned, whether it's real property in the form of a buy-to-let or whether it's shares that are jointly owned, whatever the property is, could be a bank account. The default position for independent taxation is that each of the husband and wife take a 1/2 share in the income. Now, that default position can only be replaced using an actual split that's not 50-50 if first we are looking at property that is in fact beneficially owned other than 50-50. So with real property, there would need to be a declaration of trust unless the property is being conveyed into their names as tenants in common with shares other than 50-50. So first, we've got to have the actual beneficial interest being not 50-50. And then second, if it's husband and wife, the default position will still be 50-50 unless they complete the Form 17. And the Form 17 is not available other than to married couples, I say husband and wife, registered civil partners as well. So it is not available to siblings, for instance, or cousins or family friends or business partners. It's only for married couples, registered civil partners, and only if that Form 17 is submitted should the income on their individual tax returns then follow the actual beneficial interests.
Okay, so let me give you two examples just to confirm this. Unmarried couple, they've moved in together, they've decided to rent out the other property that used to belong to her, let's say. The decision is that they would quite like to tax that in a different way to all on her. Can I fill in Form 17?
No, of course not.
Absolutely.
I mean, apart from anything else, only one of them has an interest in the property.
Exactly.
Yeah.
And they're not married.
Exactly.
Second example.
But even if they jointly owned it as tenants in common, they wouldn't be able, if it was 50-50, they wouldn't be able to displace that 50-50.
Exactly.
So if they're not married or registered civil partners, then you've got to follow the actual beneficial interest.
And then the point that I was going to make on the beneficial interest side of things, you have a husband and wife who own a property 50-50, but because of their salaries, their dividends, everything else, it would be quite nice if we could say the income was hers rather than his because it'll work better for tax purposes. So can I fill in Form 17 to change the beneficial interest?
No.
Absolutely not.
The Form 17 cannot change anything. It can only reflect reality and have that reality override the default 50-50 presumption.
And the vast majority of Form 17 questions, I mean, we have picked on Pete. The question is asked in lectures very frequently. We see it on Any Answers an awful lot. The key point is, as Tim has explained, Form 17 has a very specific purpose. It's a very useful form. We must make sure we have completed it, but it is only useful if you meet the requirements that allow you to then use it. You can't use it as the thing that pushes you into the right direction.
Can I just add one rider to that? Not really a rider, but a further point is this. Suppose a married couple owned a property as tenants in common, 80% her, 20% him. Absent a Form 17, the rental income from that property will be split 50-50. So the default applies even if it's not equally owned. That principle used to apply to jointly owned close company shareholdings, but post the Arctic Systems case, HMRC got the government to tighten up the rule so that if a couple jointly own shares in a close company, the dividend income must be split in the beneficial ratio. So if it is 80-20, then it's got to be split 80-20. You cannot default to something other than the 80-20. So if there was a declaration of trust saying that the husband owns the beneficial interest in the shares 99% and the wife 1%, that will have to be followed for their income tax returns. You're not able to put half the dividend on the wife's return.
And the point I always make on that, just to back up what you're saying, we are talking about jointly owned shares. We're not talking about he owns some shares and she owns some shares. We're talking about shares that are owned
in their
both
joint names.
names.
He might be first name shareholder
Absolutely.
on the register, she second, but they're in their joint names.
Bearing in mind most people are entirely happy with the whole 50-50 and we sort of work out Form 17, we work out how to deal with jointly owned shares. It is amazing how many people are still getting this very, very wrong. Do make sure you're comfortable with the rules when to use Form 17, and also make sure you are declaring benefits correctly, and if they're not benefits, you're dealing with the pecuniary liability correctly. Both excellent questions. Hopefully we've helped you by answering them. Do keep posting your questions, and next month it could be your question that we're answering. But for this month, bye-bye.